All right, guys, we are back. Invest with Instinct episode. I believe this is 13 now. So I don't know if that's like lucky, unlucky. As you guys said, today might have been an interesting day for you in the markets. Maybe it was unlucky. I don't know. So my bad. I'll take the blame for that one. So this is a tongue twister introduction here. Mythic markets research. First of all, thanks for coming on. It's our first episode with two people. So it's pretty cool to see a little bit more engagement here on screen. And why don't you guys go ahead and just break it down to us, like what it is you guys are doing, how you're approaching things, what your roles are, and explain to us also the name. What's the deal there? Sounds like some astrology stuff going on. So
yeah, GAM waves, right? So the name was actually a random name generator that came up. We were searching for something and wanted a cool theme, and we're not overly creative. I think that will be a theme that comes up through this podcast. We use what's at our disposal and don't believe in being super creative or trying to create something new out of thin air. But we trade futures, long, short, fully systematic at the moment. And right now we're focused on the intraday time frame.
Kyle, anything you want to add to that?
No, that's a pretty good summary. Like Grant said, yeah, we use a random name generator to come up with the name for Mythic Market. But while when we did see it, it jumped out at us. The idea of being able to show a different side of, I think, trading than people are most often used to, I guess, in the public domain. So, yeah.
It's very 2023 of you guys to use an RNG there solver situation going on. That's what I used to be in the poker world, and now poker is all solvers and probabilities and ranges and really sucking the soul out of the game. That's just kind of how it goes. But okay, so what is it that drove you guys towards this systematic approach? Why not just trade on your own? Why not just go long, go short? Why the systems? Why the modeling? Why?
Yeah, that's a really good. Yeah, it's really good. Go ahead, buddy.
So our main belief is trading as a business. That's like the underlying belief that we have. And we trade as a team. So we want consistency. We want to be able to calculate an edge, and we want to run multi-strategy. So something that we do, we categorize our systems across timeframes. And when you're trading across timeframes, it could get very confusing and convoluted. The easiest way to differentiate those systems or strategies is to 100% systematize them. So being that we're a small outfit, we're a team of four, two traders, Kyle and myself, a quant, and an advisor. We need to systematize our trading so that we could run more strategies and that we could have more consistent revenue. And you don't hear that phrase a lot in trading circles, but we want consistent profitability month in, month out.
So why more strategies than less? Have you found, well, first of all, how long have you guys been doing this? And second of all, have you found that being too dependent on one thing has been hurtful, and you need to be able to adjust to have different options and different regimes? Or what got you to that point where you felt like you needed more strategies?
Kyle.
Yeah, it's a great question. Really, what it comes down to is a couple of different things. At least from my part, it's been about 5 years trading professionally. And so before that, I had some experience basically buying long only in equities. On my side over here, I'm up here located in Canada. And so just outside of Toronto, Canada. And so for me, it was really just the truth of it was luck on just buying stock in a bull market at the time when I first started, and being too fearful to exit positions or do too much, which resulted in a pretty good performance. on that year, which is just the brutal truth of it, right? You know, the novice and coming in and getting an interest and going deeper there, expanding my level of knowledge and curiosity. And so fast forward to going into the professional side, which is, going from a place where this is a hobby essentially to now going to a place where this is a career and a way for you to make a living. And playing with our strengths, which is largely systematic. How do we know this? Well, we've done the psychological profiles that help us kind of understand who we are as traders. And number one, focusing on edges that we can capture, right? It's one thing to build models, and Grant and I have gone down the rabbit hole of trying to be novel. We've gone down the rabbit hole of trying to create new things. And what we discovered was you just had a whole bunch of complexity and issues in execution. And so for us, what we focus on is robust data. And this data, this research is accessible online. We're always watching, always learning, reading research papers, coming up with ideas. And so to try to apply one model or one execution framework to the world just doesn't work. We've tried that. We've tried it. And what we found is it's inevitably fallible for all those reasons. Regimes change, things shift, you're focused, the way you capture these edges needs to, if you're using one methodology. And so what we've done is we focus on looking at individual edges, designing and building execution frameworks for them, and then doing deep studies on how it performs over the longest period we can get access to. And then looking to add that as part of a portfolio of models. And so what we look to do by doing that is stack uncorrelated edges in uncorrelated markets, trading different time frames in an effort to generate as close as we can to consistency on. And we look at, for our intraday strategies, at least, we look at quarterly time frames to kind of determine or achieve that goal, right? We want as many profitable quarters in a row is really our the end result and goal.
Yeah, I think that's pretty sweet. So before I forget, why don't you just give us a little bit of the results on each of your psychological tests there, and like who's the degenerate, who's the scared techie guy?
Yeah, that's good. I mean, we've done. I know that between Grant, myself, and we've forced our dev to do some of these tests as well, especially when first meeting him, because it's a couple different things. And what I think we do a little bit differently as a team is we really focus on principles. And so what I mean by that is we want to make sure that when we're working together, and funny enough, I know that there was a bit of a test we had to do prior to our meeting today. I don't know if you're going to go into this at one point. I don't want to jump ahead. Please let me know if I'll be jumping ahead.
No, I would have probably forgotten it, so you can go ahead and bring it up. Yeah.
Right. All right. So there was a test. Grant sent me a link and said, "Hey, James has asked if we could please do this." I'm sure. So I fill it out, submit it, and then we post each other's results, and we both end up in the same bucket. And it's not. And I wasn't surprised at seeing the result, because Grant and I know each other fairly well, having worked together for years. And we've done the trader profiles, like what trader type are you from Van Tharp. We've done the psychological profiles. We understand how we think, how we interact, how we work together. Because what we found is, you can be an independent trader and do this on your own. And number one, it's boring, of course. And number two, you kind of end up operating in a bubble. And what I find working as part of a team is that you always have other people that can double and triple check your thinking. And then you have a dev who goes and says, "That's nice that you guys both have built this data. Let's now go and actually benchmark it. So let's go and take this idea of yours, including the execution. Let's now build this out into an actual model, an algorithm. Let's now do a back test to verify your edge. Let's do out of sample, in sample. Let's actually verify the robustness of this," right? And so our fourth partner is heavy duty into the cybersecurity and comes from that background. And so for us, working as a whole, we don't each of us have to wear 8 hats as part of a business. We get to split that level of responsibility among our team members. And so, for example, Grant in the company is the CEO, I'm the COO, and our developer is the developer, right? He's He's the guy in charge of making sure all the code and stuff is properly maintained and everything else. And so we build a lot of our own in-house products to determine correlation studies and everything else and position sizing. Yeah.
Do you have a goal with your strategies to have those psychological profiles overlap with each other? So like, you generally have a view on things, Grant generally has a view on things, and when they align, like, okay, let's build a model to then kind of execute on that? Or do you try to have opposing ones in a sense of diversifying, if that makes sense?
Yeah. So getting after like idea generation, that Kyle and I have very different ways of coming to making a system, or just how we view markets in general. Very, very different. Even though we run 100% systematic at the moment, that's what we view as our foundation. Clipping coupons is what I like to call it, just like the consistent action of extracting edge. Discretionary does have its place, but a big thing is that having systems doesn't mean allows you to not force trades, right, on the discretionary side. And we view strategies and our systems as employees. And why would we ever want our employees to, unless they're as good at discretionary trading as we are, or 80% as good, why would we want them to replicate our individual edges as discretionary traders? So we come from systems trading and that mindset to find something different and unique that we wouldn't necessarily be able to extract the edge from, but a system can. So a good example would be trading a system that has a 35% win rate. That's trend following, huge positive skew. As a discretionary trader, like, you could look at the back test or look at the edge and say you could stick with that, but very few people could actually trade that.
Sure.
So what we do is we put that into code, and all we have to do is get over the psychological hurdle of clicking the on button every morning.
Yeah, that makes sense. So go ahead.
Yes. And being consistent about that, right? And like, so developing, playing to our strengths. Like, really, for me, I'm more suited towards that consistency element in terms of the minute details of things, making sure I'm following process, checking off to-do lists, those types of things that enable you to have consistency over a long enough period of time, the showing up every day, no matter what, clicking this button here, doing this, doing that. And Grant's focus, and while we both do research, Grant is really good at providing a top level view and idea about where we're going in terms of, hey, what kind of strategies should we be looking at? What gaps have we not filled yet? Is this something that should really be considered for this or for that? And so we all play to our strengths. And between the two of us, we've really split the division of responsibility to be toward our strengths. So when you come to the river every day, you're going to the river you want to go to. You're not having to wear the hat, that you don't want to have to wear. And it allows us to focus on scalability, because really, ultimately, it is about making money. And for us, the active intraday models are purely about generating that revenue, right? In a way that is sustainable and doesn't rely heavily on us being here every day. Because ultimately, as any good business should, we want to try to offload as much of the day-to-day responsibility as possible, and eventually down the road be able to do things like hire execution traders to follow process and procedures that we've built because we've lived them, which we think it's kind of unique in the sense that we haven't seen a team kind of openly out in social media, and do things the way we do. Yeah, sorry, I don't know if I went on a little too far. Yeah,
no, it's good. I love a good long rant, like it just goes down those rabbit holes.
I'm your guy. I love ranting.
No, I mean, so what I like when I'm processing this, I'm hearing like guys who want to make money consistently every, let's just say, month, every quarter. You want to be able to look back and be like, okay, we're progressing, we're growing. To me, as a single trader who has generally a style that ebbs and flows, like since I'm just me, I'm really focused on what is the current regime and how do I best adapt how I trade to that regime in order to make money every month and every quarter, right?
Mhm.
So what I'm sensing is that by building out these systems, maybe that trend following one that's only a 35% winner, but has a huge like risk reward to it, or maybe your Kyle's a bit more focused on like, I don't know if you what you're bringing in for a process, but it could be arbitraging, hedge ratio here, like clipping just maybe a higher win rate, and then maybe grants a little bit more discretionary where you're bringing in like a macro view and going to different assets. So you're basically trying to build out in a way to capture, adapt and capture to whatever the regime at the moment is, and to be able to cover all those bases so that you can actually win every quarter. Because if you weren't able to play and adapt to each regime, like it would be a pretty hard bar to hit winning every quarter. Just because some people are so stringent on their strategy that like that strategy is not just always going to work in a certain regime, right? Like if your strategy is a breakout strategy, but like every single breakout in this regime is like pulling back and it's like an oscillating market, like good luck making money that month or something, right? Like you're going to need to be able to adapt. So am I kind of catching the drift here on that?
Yeah. So when it comes to a system, we build a system for a very specific edge. So when you to enter the trade, it has to meet regime criteria. So there's some sort of overlay regime criteria, and it could be as simple as time of day or day of week as the regime for the intraday stuff. But every trade has some filtering to it and regime criteria that is an overlay to the actual execution. So we try to strive to be specific in the execution. That way, we're not leaves in the wind, right? Like we know exactly what we're targeting.
Mm-hmm.
Yeah. To further add to it, if you think about it and take a step back and you look at a prop firm, for example, right? And you're allocating risk to individual traders that have different methodologies or different styles, whether it's systematic or discretionary. We look at our models very much the same way. And we've kind of illustrated this through the Mythic Zoo, which is our very public a way of showing how we build models and build portfolios, and that each model represents a trader. And so if we can take an edge, and for example, when we do this in the beginning, let's say we take an edge. Let's say that that gold has a tendency to move higher on Monday, Wednesdays, and Thursdays. I'm just picking random days and saying just for the sake of argument. And my goal is for me, I love building the execution systems, the systems that would capture that edge. Where's my entry? Where's my stop? Where's my target? If there is even one, is there am I holding for so many days and exiting, that type of thing? And I go and I manually build this model. That means I manually go back in time, look at charts, at all the examples, kind of strengthen my pattern recognition ability by doing it, and go through, I'm not exaggerating when I say this, hundreds, if not thousands of back tested executions on charts. When I have enough data, and Grant and I will be talking about it as the development is ongoing, of course, we'll bring our dev in and say, it's time for him to either confirm the work we've done or break our hearts when we go deep enough. Mm-hmm. So it's going to be like, guys, this worked really well for like a year and it has been complete garbage for the rest of the time. It doesn't mean that edge isn't valuable. It just means that there's other things to consider. Maybe we need to approach it from a different angle. And so with every model we take from, go through this process with, ideas first, execution in terms of trying to capture that edge verification, and then actioning it now. We put it on sim, watch how it trades in simulation, or trade it manually actually first and then take it to sim. We're always in this process of learning from our model. And when we get our model to a place that we're satisfied with the robustness that we've seen in live markets, we then turn it on. And when we do that, we're still watching the models. So when a model goes off, we understand that it should be happening. That if a trade happens, like nothing is black boxy, nothing is automatically spit out of a machine and told this right here, if you just turn this into an execution model, it'll print money. We don't do that at all. We need to understand fundamentally where the edge comes from and how the execution works so that we can trust in the model, right? And it would be the same as a risk manager on a trading floor, trusting the trader to execute. And so, a certain amount of firm capital is allocated to that trader. That trader is trading, and our goal is to fill the seats. And so there is a point in time when you hit per portfolio or overall model that, there's an element of diminishing returns in that correlation between models. If you're trading these three strategies, I mean, you might as well just up the risk in the one because they're all three robust and they all three. So maybe it's not a good fit for that particular desk. Maybe there's a different one it could add value to. And so when on our website, we have a pyramid, and it kind of highlights the way we think about a portfolio overall. If you zoom out and at the company level, how capital is allocated and risk is managed. And so our active intraday models live in the top of the pyramid that we refer to as WAND, kind of in keeping with the whole Mythic market.
Yeah.
Auto-generated, name. But we loved it because immediately in our heads, it was, this is Grant's idea. Grant's like, hey, this is great. Wand for the active stuff because it's just magic.
Yeah.
A sword for the middle.
Yeah.
And shield for the defensive models, right?
Mm-hmm.
And I was like, oh, that's beautiful. I could see it in my mind, right? It was really, really good from a vision perspective. And I think it really drives that point home. And so when you step out, you look at this pyramid. Well, if we now make this a 3D model and we turn that pyramid on its side and you see two faces, right now you're seeing the systematic one being developed. But on the other side of that is where you see the discretionary element within each category. So in other words, I love trading intraday. I love trading discretionarily intraday. I add a different value, a different edge on that end. And so let's say I can never duplicate myself completely. I could never code myself or my intuition or my feeling or, order flow. Yeah.
Not yet.
Not yet. Well, that's a good point. The scary point. But yeah, you never know where things are going. But let's say, but that's incredibly difficult from our work. We know that it's incredibly difficult to completely replicate Grant or completely replicate how I would trade. And so if I'm trading discretionarily, where do I fit in this category of things? That's the next, I don't want to say evolution, but on the roadmap of how the company develops, that's been basically the long-term
kind of trying to build like my thing's stopped. Hold on one second. But you're trying to build some sort of a roster, if you will, and balance out each kind of side of and section of that pyramid. Is that kind of the goal?
That's 100% the goal.
That's it. Yeah.
And a lot of this comes from the ideas from poker and chess. Have you heard of centaur chess? I think in one of your previous podcasts, this came up.
I'm nerdy, but I'm not that nerdy, I haven't hit chess level yet.
The combination of chess AI and humans beating just AI alone. So we don't use AI or anything like that, but we certainly take the concept of blending human and machine over and working to do that over time. So something that is super, super cool about having a portfolio of systems and sitting here and watching them every day is you learn how to trade them better.
Yeah.
Consistently. And it's insight that normal data mining wouldn't be able to conclude to. Humans, like we make a bunch of, we're good at pattern recognition, and a lot of pattern recognition could lie to us, but it's just bringing in a ton of ideas, testing it by hand, and then moving to code. And without the systems, without the base framework, the work wouldn't be as good.
Yeah. I've always felt like there's like the tactical baseline work that needs to be done, but then there's some sort of human element there that's like just so interesting that time in the seat gives you, right? Like every model could tell you one thing, but there's like something deep down that's just like, and like this just doesn't necessarily feel right, and I feel like I've experienced this time before, and like the unexpected happens here. And it's tough because when you're trying to build out models, that's exactly almost the feelings a lot of times you're trying to get rid of, because but it could be a powerful thing at sometimes too. So yeah.
I think humans, to recognize, not make a mistake again, only need a sample size of 1 if it's bad enough. Versus like a developer, right? Would be like, oh, let this comes up with our guy. I have to try to recreate that. It's not real, and it's like, dude, that was bad enough that we don't want that to ever happen again.
Yeah.
So, yeah. Sometimes the law of large numbers doesn't have to apply, and humans are good at picking that type of stuff up.
Yeah, that's right. So how are you guys like, you're building out your roster on your pyramid, it's kind of what we do. We have, I don't know, 150, 200 traders at the firm that I work for. And, everybody is siloed off, whether it's an individual trader like me, an algo team doing calendar spreads, 4 individual traders working together with macro models. Like it's all sorts of different things, and they don't necessarily communicate with each other. So in the grand scheme, from the top, like the top down view from the partners, it's like they're doing the same thing as you with humans, right? Like they're just doing it by hiring people. So I completely understand kind of your goals here, and I think that's like a really good idea, because cross-pollinating the same general idea is probably a recipe for like, it could be good for a while, but then it could lead to ultimate disaster if they were competing ideas. So like, with that being said, how are you, let's say you're like, something's running okay. Are you allocating going overweight into certain players that are doing well and benching other players, or are you just letting them all run because that may shift? Or are you kind of monitoring it and be like, no, we need to push the edge over here, now we need to pull back? Does that question make sense?
Yeah, that makes a lot of sense. We do a lot of risk modeling before we put a system on, and we trade. The risk is predetermined, and we're not going to overweight or underweight as performance changes going forward. We run Monte Carlo simulations to get an idea of the range of outcomes, which is like super standard practice. And it's just to really know when something's broken, or if something has run super, super hot, we want to know. So somebody asked us an interesting question. They said, if it's outside of the 1 standard deviation of performance that you expected based on Monte Carlo, would you turn it off? Because to the downside, we would. Right? And the answer that we come back to is we probably should cut risk in half and invest, like come up with some reasoning why this was outside of our range of expectations at the very least. There could be structural changes in the market, but those don't happen often. There could be regime changes that happen slower, and getting data that goes back far, like really far, that's really clean, is hard to get. So that could be an explanation, but you wouldn't treat the upside surprise the same as the downside surprise as a trader, and that still happens on the systematic side. So everything's modeled out for correlation, and We have max exposure limits on different contracts,
Mm-hmm.
and we have predetermined sizes, and we let everything run, and we don't vary the size of the model going forward. We try not to.
You keep it to 1,000 lots in ES, I assume, probably.
100,000. Also, to your earlier point, I also don't play chess, but I love talking about it. So yeah, I also don't know my way around a chessboard. But when it comes to the risk model, like Grant was saying, to add further insight to it, is that when he says we look at it prior, we're really looking from because of how long of a time horizon we're looking at. There's many different ways you can look at sizing with our models than from the work we've done. And it just depends on, are you doing let's say 1,000 period rolling analysis type of thing? You're looking over the past 1,000 days, right? If you're looking at a portfolio of things or the past 1,000 trades and looking at that performance and coming to some kind of conclusion, well, we look at the whole data set. We're willing to sacrifice short-term periods in its life for more robustness of the overall portfolio. We're willing to make that sacrifice. And it's also because, none of us here want to be, it's kind of like walking through the woods. If you're painting the trees on the way in, you have a way to get out.
Yeah.
If you go in and you don't do that, or you're doing it, but now you're using different colors and, you've chopped down some of those trees, you have no idea where the hell you came from. Mm-hmm. And this is a problem that you can easily slip into with systems trading or even algorithmic trading. Is, there's looks like a little bit of a problem. Let's change things. Now let's incorporate style drift. And that even includes the risk side. If we've done the work and we're confident in its robustness, we've kind of alleviated some of that risk by just trading multiple models that we trust. And so if there's some kind of bad event, if something happens, one of the markers it'd be like something so unusual happened that it caused a model to just break. Let's just say an edge just evaporated. Well, our goal as a team is always to be constantly working on things. Like for every model we actually have fully ready, fully tested and ready to go, we have a ton of stuff on the shelf that needs to go through this process. And it just takes time, right? So how much time do you want to spend rejigging, looking over risk models? We try to just stay out of the way.
It's like I have a trade idea, and I built this trade idea in my head. There's 4 reasons I like the trade, and now I'm in the trade, and I'm starting to tinker with my ideas and adding or taking away from the thesis is now stronger because of this macro thing, and I'm like, when really you kind of had your original idea, and like maybe that other stuff can be part of a new thing. But if you start tinkering with that idea, you're only going to potentially mess up what you've built from the foundation. Exactly. Kind of what you're saying.
Yeah, exactly. Yeah. And just to kind of add further clarity too, we don't mean that it's all risk the same. I mean, we have some models that are like, let's say 65% win rate over their history of the past since 2008 to present. And, they have a profit factor of 2 or more. Let's just say in some case, let's say it's 2.5 profit factor with a 65% win rate. Yeah, we're going to give that guy more juice. But it's within reason. We would never allocate a 10% risk budget to that.
And that's probably coming around maybe a little less often or something like that.
Yeah, it trades less frequently. There's less frequency with this model. So we're willing to, because its turnover is less and its profit factor is more, we're willing to give it more risk. But it's always going to be within a certain amount. We'll never use random like a random percentage, even though it may look beautiful. We can't count on that edge always being
good
there.
risk. Good risk management from a growth perspective, right? Because you could maybe finagle with it now, like when you guys are smaller. But if you get up into this, echelon where you're going to be trading huge size, eventually you can't just like dick around with like percentages like that, right? It's quite a big deal. So how do you how are you prepared for, let's say you're running some models, right? Like you got them all activated, you've got one trade on or whatever, things are just a normal day. And then we have like, invasion in the Middle East, right? I trade futures. I understand what happens, right? So like you're going to have algo driven shock initially, you're going to have reaction to that. You're going to have a lot of convoluted movement in there until a direction is maybe resolved and going. How is that for you? Is that bad for you guys? Is that good? Like, how does this generally work for somebody who's running like systematic stuff?
Generally, for our stuff, that's good because we're trading a big portion of our trading is to accept risk. So while we're in positions, we tend to accept more volatility in the position than I'll say competitors in the marketplace are willing to accept. We're not risking ticks. We're risking ATRs on an intraday basis.
Sorry, what's that?
Average true range.
Okay, I got you.
Like it's like taking a standard deviation or some volatility stop, right?
Some sort of
and we're doing a multiple of that. Which means our sizing inherently is smaller than I'll say most intraday futures traders. Part of that is lack of execution edge. Like we're not prop shop with latency edge. We don't have order book. I'm in Scottsdale and he's in Canada. So we use that to our advantage by just being willing to accept more volatility in the position. What that allows us to do is actually exit when we're wrong, not because we lost a certain amount of money or some percentage risk. It's like if we get stopped out of a trade, we hit our stops 10% of the time or something like that. That's how far away our stops are. Like it's really bad. Like the trade has to go really bad against you to hit those stops. So that's generally how we manage it. And on an intraday basis, to give you even more context, our average holding period is 6.5 hours. Yeah. So that's a long time compared to a lot of intraday.
So like, all right. So let's say you're currently short gold, right? And this Middle Eastern thing happens, and it didn't happen on a weekend, and it happened whatever on a Tuesday. Gold goes up 150, 200 ticks, and then it kind of sits there for a while, and your stop is another, let's call it another 150 ticks away. Do you then step in as a, sorry, my fucking camera again. Do you step in as a human there and say, you know what, like, I need to exit this trade because of so-and-so? Or are you just like, hey, man, this is the system. The system has worked in that potential, and we're just going to stay short gold here, and we're going to accept the loss?
Yeah, it's a great question. We're going to accept that loss. And the reason why is because, you know, it's, we really work hard not to move away from what has been tested and all the hard work we've done. It's kind of like, you know, there's always going to be a degree of randomness no matter what after entry. And so we accept that random. And that kind of goes back to the whole principles element of what I was saying before, right? What are the principles? Well, you know, one of ours is that we just accept the risk we take. And accepting that risk means, you know, that we've position sized it appropriately for the time, even with, let's say, horrible slippage on the way out. It's not a catastrophic day or event by any means. It might take what would normally have been a 1% losing day to, let's say, with horrible slippage, really bad random event. You know, maybe let's call it 3 times that amount. Let's call it 3 times that amount, which would be really hard to do based, like Grant said, based on our size. But let's just say that we include that in that understanding and acceptance of risk. You know, Grant likes to say this, and I, of course, agree. You know, I very much feel the same way. You know, these models are extensions of our beliefs, not only in execution, but also in terms of risk. That they really are. So it would be like me interfering with me.
Yeah.
Right. Or Grant interfering with Grant. We really do see these models as extensions of us. Our hands in the I don't know, what do you want to call it? The dough? The pudding? Yeah. Where do you put your hands? I don't know.
Not pudding.
Some like maybe not not pudding. Cookie jar. Cookie jar.
It's such a Canadian right there, dude. Jesus.
Hey,
imagine the latency up there. Like the dial-up service or whatever the fuck you guys.
It basically is. I lose some internet connectivity between virtual chats with the team at least once a week, something like that.
Yeah, and to add on to this example, something that we're working on right now and in the process is like building out the contingency plan. So, like a simple one is a backup broker because, God forbid, IB goes down, right, during that invasion, right? That would be worse than the invasion, to be honest. Like a broker outage or anything like that. So hedging in options markets when futures go limit up or limit down, right? Like knowing how to get flat in your position with the products at your disposal, because the future might not be trading anymore, but the options definitely are, right? And those don't have limit up or limit down. So it's building out a comprehensive risk plan and contingency planning where anytime you put on a trade, you have a way out. And there could be something terrible that happens, like a market closure for 3 days. But that everybody's in the same boat there. You're just,
I mean, they're very stringent about that type of shit. Like for us, like we have physical cards on hand that like, hey, if ICE or CME or something like that goes down, there's a phone number to call. I have 3 buddies I can text and be like, buy me this or sell me that if I lose connection. Knowing how to get out in like a back calendar or something if you're stuck at limit up or down. Like, and again, it's good that like you guys are doing this now because again, it's not so much about you guys now. You can probably deal with it, but if you grow and you have 8 people working under you, they better fucking know all that stuff, right? Or else they could cost you guys the entire situation you're trying to build here.
Yeah, exactly.
For instance.
Mm-hmm. And we make sure to be on the right side of the Kelly curve, like so not even close to getting what people would say optimal position sizing, based on that model. So it's
you basically you're limiting your blowout risk to like 0, as close to 0 as possible.
1%, right? Like 1% would be a lot, but
that's kind of how I operate. I've always lived by this mantra of like, don't lose my seat at the table, right? Like the last thing you want to do is not be able to play in the game. So like I'm more of a consistent winner, a lot more volume, but I don't put on huge size. I'm more of a medium sized trader and stuff because sleep at night risk, if I'm holding positions overnight, if I want to avoid those blowout catastrophes, I don't even like that being in the realm of possibility for me.
Yeah.
Right. It's just too much. Cause I've heard stories by now, good traders that careers just kind of go by the wayside because of one little mistake on that front. Weird world.
Yeah. It's a good point. And even for us, just to kind of highlight some more of the risk side and the contingency planning, because our models do come from a manually built place, that means that the models would have had to have gone through a process of manual execution. So if you think about that, right, it's like if I'm up here in Canada land and, I'm not going to be trading at 4 a.m, right? And so because that work was not completed. So it needs to come from a place of actual execution. And so, for example, between Grant and me, we have a time zone difference. We use that to our advantage. We even have an execution calendar that lets us know when things should be trading, when they shouldn't be trading. And we look to fill gaps in that execution calendar rather than overlay models. And so what that means is even in those events, when you have a really bad offside event, it's likely we only have one model on at that time, 1 or 2 maybe. And they're kind of one helping the other, like we're in right now, and then we will scale in with a different model at a different point in time if certain criteria is met. And so our exposure is quite limited on a day-to-day, hour-to-hour basis. That makes sense. Like we might be in a position for a while, but.
And you also like if you were in like since you guys have such like larger downside, I don't know what to call it. Like you're giving it breathing room on a lot of your strategies, right? So let's just say you had a few on and it's going that 4, 5, 6, 7 hours and it's just chilling. Like if you don't have the other risk available to you and your other system over in left field gets triggered, it might not have the capital to do so if you're still risking big on these other positions, right? So you'll always have the liquidity to continue running what you're trying to run.
Yeah,
Yeah.
it's 100% it too. Go ahead, Grant. Sorry.
Yeah, everything's sized so that everything could run at once. We don't want to ever be in a position where we can't take a signal from one of our other systems. Right now, we're running 3 core systems, and the reason I say core is that there's some variation amongst them to meet some different product specs, right? So like trading NYMEX hours versus CME RTH and all, like there's some modification that has to be changed for those considerations, and like some news events and intraday seasonality of different products and stuff like that. So there's some variation, but right now it's 3 systems, and a big part of reducing risk for us is to trade a big basket of futures, and most of our systems all 3 of the systems are positive skew at the moment.
So what I'm gonna do this again. Sorry. What in this regime that we're in now, what would you say is like your favorite products to trade? What are your systems running in now? And then also like what is your overall thoughts on markets today? Because to me they're pretty interesting and they're ever changing. And I'm still trying to figure it out. I'm still trying to adapt. So are you guys excited about what's going on now? Have the products you've been trading, have you been seeing success in them recently? Are you starting to look at other things? So what's your current thoughts?
Gold on Fridays is fun.
Gold right on Friday?
Now. Well, all the threat, this sounds like terrible. All the threat of invasion and all the Middle East news, like, creates absolute drama going into the weekend. And everybody wants risk off. So it's gold and crude on Fridays. and we're like, we like that trade. It pans out pretty well for us.
So you're basically saying kind of get filled on the long side Friday afternoons as everybody's risk off and kind of play the gap up or whatever on Sundays?
Well, we're going to be flat over the weekend.
And just hope there's no peace treaty? Oh, you're okay. So you're I see. So do you like weekend risk or no?
Yeah, generally speak, like we're talking about mostly about our intraday stuff, but we do like weekend risk. Again, I think something that has been really sad about our industry is in finance in general is that nobody's willing to accept risk. Mm-hmm. Everybody wants super high Sharpe, low vol, just give me 7% a year with a 6% downside. Type of situation, which is okay, but we're in the business of accepting risk and taking risk, which means slightly more vol and like maybe some slight discomfort. It just means sizing smaller, in general. So
and it pays like the experience of that feeling and those like, you know, if something does happen, like you said, having a sample of one can be really powerful sometimes, right? Mm-hmm. To have held, you know, some people I know, they would get long stocks when the VIX was low. It's just get long stocks Friday, get short stocks Friday when the VIX was low, and then basically just hope for something bad to happen over every weekend. And when it didn't, it would just open up at like settle price or whatever. It's just very rare to see like some really good weekend news come out, right? Where the stock could gap up at you when the VIX is at like 13. Yeah. So introducing that acceptance of risk is pretty interesting. I'm with you on that side of things. But yeah, and there's that saying of like, risk never leaves, it's just transformed into something else, right? It's like energy or matter or whatever. And so that's the question I keep asking myself is like, where has the risk been like morphing to? Because you're seeing a lot in bonds and stuff, but I'm like, you know, traded a long time, like there's risk out there that's way greater than what we're seeing, you know what I'm saying? And I personally feel like there's, I keep saying on Twitter, like it's like a bike speed wobbling or like a, you know, but nothing's really crashed yet. Like there hasn't really been a volatility spike, but it feels like it could happen. So yeah, like it's interesting to hear like the gold situation. I think you guys said you trade stocks, gold, crude. I mean, you trade probably everything, but like those are generally the few that you're kind of in and out on daily.
Yeah. So to give you an idea of universe at present, with our live models that are trading live capital, our universe is the indices. We have Bitcoin as part of that universe, although that's not been put on live yet. That's been tested live, but it's not been put on live capital yet. Gold, silver, crude, gasoline is another one we trade. We do trade some of the currency futures. And yeah, so like we try to trade as many products as we can within reason, of course. It has to add value and serve a purpose to the portfolios we trade. But yeah, we try to keep it as we're always looking for new things to add.
Yeah.
And every time we add something, we can control risk further. You know, if we can achieve the same outcome that we're targeting with reduced reduced volatility necessarily, but reduced risk, with every model we add, we can further reduce risk across the board per model.
Yeah, you can add volatility to decrease volatility in a way.
Yeah,
right?
That's right. Yeah, that's right. Yeah.
Well, play more hands, right? More models is playing more hands. More trades a year means you could reduce your risk per trade and get a similar outcome.
Yeah. So that's cool, man. That's it's really cool to see what you guys are doing. Like, what have each of you, like, what's one thing you've like kind of taken away from starting this venture? You know, I worked for a firm, so like it's a little bit, it's easy for me. I log in, I get all the things I need. I'm not building a company. I'm not hiring a quant. I'm not doing any of that shit. So what's some of the interesting takeaways from you guys so far? And what do you kind of, what are your big goals here? You want to grow this into something that you can look back on and be like, wow, look at what we were really able to do there. Or is it more of like a couple year hobby? Like, what is the big goals here?
Yeah. So
you guys hate each other. Maybe you hate each other by now.
Fortunately, amazing partners. All four of us are amazing. The biggest takeaway is, well, the biggest takeaway is how much longer everything takes on your own. So there's nobody backstopping us, which is nice. There's nobody telling us no or pushing back. However, everything takes 3 times as long as you think it would. And well,
it's those damn devs. They just can't get it built quick enough, you know?
Well, it's the lawyers, it's the accountants, it's everybody.
Yeah.
So how it's amazing how much time back office work takes. So just when you're doing it out on your own, just be prepared for it to take 3 to 5 times as long as you think it will. And also, the other big lesson is you need to really, really, really be prepared for down quarters when it's your livelihood. And can't state that enough for independent traders. But on the business side, like, we have a whole financial plan of building what we're calling a vault, right? And it's literally money put aside that we are counting as profits that we're taking out of the trading on a quarterly basis and putting aside that either distributes to the equity owners and the owners, or is a portion reinvested into infrastructure in the business. So those are the big takeaways. Like financial planning, like a good financial plan to treat it as a business, and expect everything that you do back office wise to take 3 to 5x longer.
That's good to know. Kyle?
Yeah, on thinking through the question, I think that it's easy, especially for depending on where you are in trading and whoever may be listening, if it's a first year endeavor, understanding that really when you structure things as a business, you don't have the ability to treat it like a hobby. So you can't be half-assed, right? The goal is to make money. And I find that what I've found, at least in my journey, was that there was a lot less emphasis on the money-making element of a business, which is trading, if you're doing this for a business purpose. And you see that in the proofs of who's speaking. And so what I mean by that is it's something I've come to realize over years rather than something I was looking for in the beginning. Because if it's an entire focused approach to trading, then it also accounts for and includes the financial side, which means what do you do with profits? What do you do with managing them? How do you deal with taxes? How do you deal with all the administrative stuff that comes alongside this business, like any other business? And so for Mythic, for us, there's a large emphasis on that, which is why the models we deploy are generally the employees that create revenue alongside our consulting services that we offer. But that's a huge revenue stream we're working on. And the reason why is because we want to be able to also add the discretionary side on that pyramid, of course, when you shift it on the side, multiple different streams of income coming in from different sources with low overhead. That's the goal, right? And so you have to plan
Sounds like
for
the dream.
Yeah, like that's the dream, right? And so road mapping the future is always a lot of fun, because you can kind of begin to doing things systematically. Well, there's never ever you never know where you are in the sequence of trades and the distribution of return, and you don't know where you are in the next week, 2 weeks, 3 weeks. But if we lean on our edges, right, we can definitely within a few quarters, years, come to some kind of understanding on expectation on return. It turns these models from just trading them manually into employees that can work for us to help generate this revenue. And all we have to be is really good risk managers and overseers of them, and maintenance people, of course, too, right? Maintaining these models. And so what that does is it allows us to take that information and now build things on the administrative side. When we put on the COO, CEO, and then the CTO hat, we sit here and we can now look at the pro formas, the cash flow analysis, the budgeting, right? The things that allow this to be a really great cash flowing business. And I think that doesn't get discussed a whole lot from the individual trader, private trader side, right?
Yeah.
It's always about edges and execution, and
you're only as good as your last trade, pretty much. That's what it's all about.
Yeah.
We're only as good as our last 100.
Huh? So you should ask every trader, right? Show me your last 100 trades.
So
that's really cool, guys. I hope it works out. I do hope you come up with a better name than the Vault. Okay, you had a really long start with the wand thing, and then I was hoping for like Hogwarts or something would be where you're putting your money, but the Vault, I don't know. I don't know if I'm on board.
It's yet. Internal. Actually, there's it's what we're pursuing, and I'd encourage all traders to read this book. It's called Profit First. It's a book on startups, but I think it applies perfectly to trading. And the whole point is how do you make room for profit is the essential point. Like you have to think that profit equals revenue minus expenses, obviously, but he flips it and says that you make room for profit and you fit your expenses down. You work your expenses into that profit margin. So that's how we've been able to get this thing started, and it's the path that we're really pursuing hard.
Yeah, I mean you're lean, right? 4 people right now, kind of like just doing it as kind of gritty and like you call it like sweat equity as you can, building all the models and then going from there. So that'll be
Yeah.
cool to see and follow along if we look back in 2 years, 3 years and you guys have a ton of systems running, a group of 20 people, whatever it may be. So yeah, good luck to you guys for that. Sounds awesome.
Thank you. Thank you very much.
And go USA. And we will catch up. Let's do this again in like I don't know, we'll follow up in a year and see where we're at.
That
Sounds
sounds
good. That'd be
perfect.
great.
All right. Any last words or where you can people can find you on X and wherever?
Yeah, on X, we're at Mythic MKT, and we have a website, mythicmarketresearch.com. You could submit a form if you want to reach out or just DM Kyle or I will respond on X for sure. And we have a Substack.
Oh, Substack game is strong. How
Yeah.
about you, Kyle? Any last words?
No, just echoing what Grant said, and also one more thing to add: we are taking our process and kind of building in public, and so we have something called the Mythic Zoo. That basically what we've done is we've personified some of our models, the models that we've had on the shelf, essentially, right, that are great, and putting them to use in a really public way. And so what we're doing is basically broadcasting the trades as we have them, and broadcasting the exits, and then doing weekly and monthly reviews of how the models have been doing. And so there's one that's kind of like, I don't want to call it the evergreen, but basically kind of like the underlying model, the zoo, and then the Vaqueros models, which are the FOMC traders. they trade on FOMC day. And so, yeah, so we're kind of gamifying it a bit, kind of making it interesting and fun. And so, yeah, we encourage people to follow along and
can people like I think that'd be interesting to hear you guys review after a month. Is that something that anybody can like join?
And we do a monthly write up on the monthly review, and Mondays we do a weekly podcast.
So professional, guys. You almost had it. We were almost done.
Such a child. But
yeah,
we do Mondays weekly podcast to review the trades. The whole point is to build in public and journal the process.
Yeah,
that's cool. It's ballsy. Not many people do it, and it's awesome to put it out there and live and die by the trade. So props to you.
Thank you.
And thanks for tuning in, guys. And we'll be back later this week with somebody else. I have no idea who. But yeah, this was a great chat, and good luck out there. See you guys.